Have you ever wondered how you would spend $1 million, 100 million, a billion, and $19 trillion? Well, that's the amount that vanished from the markets in just a few months. We're talking about the 2008 financial crisis, the worst economic disaster since the Great Depression. The roots of the crisis go back to the early 2000s, right after the dot-com bubble burst. The economy slows down, and the Federal Reserve does what it always seems to do, slash interest rates, and a lot. At the same time, the US government pushes hard on the idea that everyone should own a home. The result? A spectacular housing boom, with prices soaring and mortgages flowing. To keep the engine running, lending standards started to melt away like snow in the sun. Subprime mortgages were born, given even to people with no income, job, or assets, the infamous ninja loans. Meanwhile, deregulation opened the door to the shadow banking system, a world of investment banks and financial players doing the work of banks, but without the rules. In 2004, the SEC relaxed leverage limits even further. More debt, more profits, more adrenaline. What could possibly go wrong? Banks didn't really care about the risk because they weren't holding the mortgages anyway. They packaged them into fancy-sounding financial products, MBS, CDO, and sold them to investors around the world. Credit rating agencies, paid by the very banks creating these products, used overly optimistic models and handed out AAA ratings like candy. The prevailing idea was simple. Spread the risk far enough, and it magically disappears. Spoiler alert, it doesn't. By 2005 to 2006, the housing market hit its peak. Then, in 2007, housing prices started to fall. That's when the house of cards began to wobble. Millions of families couldn't pay their mortgages, defaults exploded, and those supposedly safe securities turned out to be anything but safe. In 2007, dozens of subprime lenders went under, and two Bear Stearns hedge funds collapsed. By 2008, the crisis went full panic mode. Bear Stearns was saved at the last minute. Fannie Mae and Freddie Mac were taken over by the government, Lehman Brothers went bankrupt, and AIG was kept afloat with a massive public bailout. Congress rushed to pass the $700 billion TARP bailout, while the real economy paid the price. Millions lost their homes and jobs, global markets crashed, and the crisis spread far beyond US borders. In hindsight, the lessons are clear. Deregulation without safeguards is dangerous. And above all, complex doesn't mean safe. Reforms like the Dodd-Frank Act and Basel III rules followed, but recovery was slow and painful. The scars of 2008, foreclosed homes, lost jobs, and shattered trust, are still visible today.